What if I told you there's a brand new ETF with a single goal? To pay you a 25% yield every single year. Not 6%, not 9%, not even the 15% that already sounds too good to be true. We are talking about 25% annualized, paid out monthly. Now before you roll your eyes, I get it. Every few months, something like this shows up, creates a wave of excitement, and then quickly becomes a cautionary tale. But this one is different because it's built on a strategy that almost nobody is talking about yet. By the end of this video, you'll know exactly how this system works, what makes it different from typical income funds, and the real risks most investors are completely overlooking. The fund is called the Simplify Anchored Target 25 Distribution ETF, ticker XXVY. Its objective is simple: deliver a stable annualized distribution yield of 25% after fees. If it hits that target, a $10,000 investment would generate roughly $199 per month. Now let's look at the average investor's reality. The S&P 500 historically returns about 10% total. Traditional dividend portfolios give you maybe 2 to 4%, and bond funds are sitting around 5%. In real dollars, a $100,000 portfolio at 5% only gives you $416 a month. That doesn't even cover rent in most cities. This is the gap that XXVY is trying to close using a fundamentally different math. So how do they generate 25%? The secret is a barrier option strategy. This isn't a gimmick. It's been a staple for big banks and institutional investors since the 90s. But now it's finally available in an ETF. Instead of just buying stocks, the fund sells crash insurance on volatile individual stocks. It's called a barrier because there is a predetermined price level. As long as the stock stays above that barrier, the fund collects huge premiums and pays them to you as income. However, the higher the yield, the higher the risk. Targeting 25% means this fund is taking on significantly more volatility than your average income fund. Now here is the part most people won't tell you. According to the fund's own data, approximately 87% of XXVY's distributions are classified as return of capital. This means that for every dollar you receive, 87 cents is technically just your own money being handed back to you, not actual profit from the market. While this can have tax advantages, it means the true income generation is much smaller than the 25% headline suggests. The fund even states in its filings that it does not guarantee meeting its target without returning your capital. In fact, recent payouts have already started to drift slightly below that 25% mark. So is XXVY a serious investment? It's only been trading for about 5 months and hasn't faced a real market crash yet. The share price has already declined from its launch range, which is exactly how the math is designed to work, but it's still a risk. This is not a core holding for your life savings. If it belongs anywhere, it's as a small satellite position in a diversified portfolio. XY represents a fascinating evolution in high-yield ETFs. But remember, in finance, a 25% yield always comes with 25% more responsibility to watch your downside. Size it carefully, monitor it closely, and always do your own research. Let's go deeper into how that barrier actually works. In a regular put option, you're on the hook the moment the stock drops, but a barrier put is different. You only owe money if the underlying asset crosses a specific threshold, the barrier, at expiration. Think of it like a safety net that only breaks if you hit it with enough force. XVY collects high premiums because it's selling protection on high volatility individual stocks. This is why the yield is so much higher than S&P 500 funds. But here's the catch. If that stock crashes past the barrier, you are fully exposed to those losses. There is no floor to save you once that line is crossed. It's a high-stakes game of staying above the line. What makes XXVY unique compared to other barrier funds like SPAR is its dynamic nature. Most funds use a fixed 30% barrier, but XXVY adjusts its barriers constantly to maintain that 25% target. If market volatility is low, the fund has to take more risk, meaning a tighter, more dangerous barrier to keep the cash flowing. If volatility spikes, it can afford more protection. This means your safety net is constantly moving based on what the market allows. You aren't getting a fixed level of safety. You're getting whatever safety 25% yield can buy at that moment. It's an aggressive approach that prioritizes income over a stable floor. XVY doesn't just play with safe, boring stocks. To hit a 25% target, the fund strategy specifically targets high volatility names. Why? Because more volatility equals more premiums, which equals more income for you. While broad index funds rarely drop 30% in a month, individual high-growth stocks do it all the time, especially during earnings season. By referencing single stocks instead of broad indices, XXVY is betting on specific names staying stable. This introduces event risk, the kind of sudden drop that a single bad news headline can trigger. You're not just betting on the market, you're betting on the survival of specific volatile companies. Let's talk about the actual payouts. To hit a 25% annual rate, the fund needs to generate just over 2% net income every single month. In a high volatility environment, this is achievable. But we've already seen the payouts start to fluctuate. For example, in March 2026, the distribution was 48 cents per share, down from 50 cents the month before. At the current share price, that annualizes to about 24%, just slightly under the 25% target. It's a small drift, but it's a reminder that even the most sophisticated institutional strategies aren't perfect. The target is aspirational, not a legal guarantee, and you need to be prepared for those numbers to shift. Finally, we have to talk about the size of the fund. As of now, XXVY is a relatively small and thinly traded fund with about $50 million in assets. This means while getting in is easy, getting out of a large position during a massive market crash might not be as smooth as it is with bigger ETFs. Also remember that since its launch in November 2025, the share price has trended downward. While you are collecting that massive 25% yield, your initial capital might be shrinking. This is why XXVY is a tool for professional-level income seekers, not a set-it-and-forget-it savings account. Use it as a satellite position, keep your size small, and always respect the math behind the madness. That's the truth about XXVY.